Hello everyone and welcome to Momentum channel. My name is Mo and in this video we'll review 3 top stocks to buy or watch right now in the stock market as they are undervalued stocks to consider. We'll review these stocks based on a number of factors including their intrinsic values, their income statement, balance sheet, their dividend payments and how they've been raising their dividends if any in the past several years, and lastly how we envision the stock prices to actually grow over time and what is the kind of certainty level that you can have when it comes to these stocks. I've put a lot of efforts and time to prepare this video, so I hope you find it beneficial. With that said, I really appreciate if you give this video a thumbs up and let's get into this video. The first undervalued stock to review is McKesson Corporation. This stock, which is listed on the New York Stock Exchange with ticker symbol MCK, was last traded at $169.87 US dollars, but it is showing a fair value of $196.82 based on its real or underlying intrinsic worth. This shows an upside of 15.9% growth with a medium level of uncertainty, making it a great undervalued stock to buy or add to your watch list right now. The fair value is calculated based on Finbox fair value methodology and allows investors to find companies that are being traded at a margin of safety compared to their fair valuation per share. McKesson is a prominent player in the healthcare providers and service industry. It provides pharmaceuticals and medical supplies in the United States and internationally. The company operates through 4 segments: US Pharmaceutical, Prescription Technology Solutions, International, and Medical Surgical Solutions. The US Pharmaceutical segment distributes pharmaceutical drugs and other healthcare-related products. McKesson is expected to get a huge earnings boost through its distribution of the pandemic-related vaccines very soon. McKesson is already the largest distributor of seasonal flu shots, and it served a similar role during the Influenza A H1N1 vaccination campaign several years ago. The company is already in the process of standing up several new facilities and adding up a lot of new employees to support the pandemic vaccine effort. McKesson will serve as a middleman in distributing pandemic vaccines, and while it will not decide where to send them, as that's up to the states and other jurisdictions to be decided, the company will definitely profit from a significant deal coming as a result of it. Earlier this week, Jim Cramer, the famous host of Mad Money show and a former hedge fund manager, explained why he's recommending the stock of McKesson to investors looking to get exposure to vaccine logistics. He added that McKesson is selling for roughly 10 times next year's earnings estimates and they deserve to be at a much higher price. He betted that McKesson has a lot of room to run. Looking at McKesson's financials, we notice that company's revenue and net profit has been steadily growing over the past several fiscal years. As for the company's balance sheet, their total assets well exceed their total liabilities in the last fiscal quarter, suggesting that McKesson has enough resources to meet its long-term obligations. However, their current liabilities slightly surpasses their current assets, which can be a little bit of a red flag, but the difference between the two numbers is just too close to be worried that much about. Looking at peer benchmark review, you notice that McKesson had a 1-year stock return of 12.8% compared to an average of 3.5% return for the healthcare sector. From a stock volatility perspective, this stock has a beta of 0.81, which is virtually the same as the beta of 0.80 for the healthcare sector, suggesting similar volatility levels in the stock price for McKesson compared to the sector median. Beta is a measure of the risk arising from exposure to general market movements, and a lower beta level typically suggests that you can expect lower volatility for the stock price. McKesson does pay a dividend and currently has a dividend yield of 0.99%. Its ex-dividend date is November 30th, which means that if an investor owns shares of McKesson before that date, they will be subject to the upcoming dividend payment of 42 cents per share, which will be paid to them on January 4th of 2021. It is worthwhile mentioning that McKesson has increased its dividend payments steadily over the past 12 years. What's more, they have a very low payout ratio of just 12.84%. This presents a huge opportunity for the company to grow its dividend in future. If you're not familiar, the dividend ratio is the proportion of company's earnings that is paid back to shareholders as dividend. Ideally, you want the payout ratio to be smaller and no larger than 60 to 70%, because that gives the company more room to grow its dividend in future and also allows the company to invest some of the money back into the company and grow the business. Looking at McKesson's last quarterly earnings report, which was announced on November 3rd, the company had earnings per share of $4.80, which showed a 23.7% positive surprise compared to analyst estimates. The company reported revenue of $60.8 billion, which surpassed analyst estimates by 2.5%. McKesson's next quarterly earnings is scheduled for February 2nd, 2021, and the company is estimated to report revenue of $61.82 billion. You can see at the bottom left graph how the stock price has reacted after earnings reports for McKesson. Within the past 8 quarterly earnings reports, the company's stock has increased 7 out of 8 times after the report's release. Alright, moving on and looking at our second undervalued stock to review. Next, we have Johnson & Johnson with the ticker symbol J&J, traded on the New York Stock Exchange. This stock was last traded at $146.36, but it is showing a fair value of $160.43 based on its real or underlying intrinsic worth. This shows an upside of 9.6% growth with a low level of uncertainty, making it another great undervalued stock to consider or buy right now. Looking at Johnson & Johnson's financials, we see a growth in the fiscal net profit over the past 3 years. As for company's balance sheet, their current assets well exceed their current liabilities in the past several fiscal years, which results in a current ratio of over 1, suggesting that Johnson & Johnson has enough resources to meet its short-term obligations. Moreover, their total assets also exceed their total liabilities. Johnson & Johnson is showing a healthy cash flow from its operations over the past 3 fiscal years. Looking at peer benchmark review, you'd notice that Johnson & Johnson had a 1-year stock return of 10.2% compared to an average of 3.5% return for the healthcare sector. From a stock volatility perspective, this stock has a beta of 0.69, which shows less volatility for this stock and its price when compared to the beta of 0.8 for the healthcare sector. Johnson & Johnson researches and develops, manufactures and sells various products in the healthcare field worldwide. It operates in 3 segments: consumer, pharmaceutical, and medical devices. The consumer segment offers baby care products under the Johnson's brand, oral care products under the Listerine brand, beauty products under the Aveeno, Clean and Clear, Neutrogena, and Ojix brands, over-the-counter medicines, including acetaminophen products under the Tylenol brand, cold, flu, and allergy products under the Sudafed brand, allergy products under the Benadryl and Zyrtec brands, ibuprofen products under the Morten IB brand, and acid reflux products under the Pepcid brand. This segment also provides women's health products such as sanitary pads and tampon under the Stay Free, Carefree, and OB brands, as well as wound care products comprising adhesive bandage under the Band-Aid brand and first aid products under the Neosporin brand. The pharmaceutical segment offers products in various therapeutic areas, including immunology, infectious disease, neuroscience, oncology, pulmonary hypertension, and cardiovascular and metabolic diseases. The medical devices segment provides orthopedic products, general surgery, biosurgical, endomechanical, and energy products, among others. Johnson & Johnson markets its products to general public and retail outlets and distributors, as well as distributes them directly to wholesalers, hospitals, and healthcare professionals for prescription use. Johnson & Johnson was founded in 1886 and is based in New Jersey. Johnson & Johnson pays a dividend, and it currently has a dividend yield of 2.76%. Its ex-dividend date is November 23rd, which means if an investor owns shares of Johnson & Johnson before that date, they will be subject to receiving the upcoming dividend payment of $1.01 per share to be paid to them on December 8th, 2020. The company has increased its dividend annually for the last 49 years, which is simply remarkable, proving it to be a true dividend aristocrat. What's more, they have a decent payout ratio of 60.77%. As I indicated earlier, I prefer the company's payout ratio to be under 70%. The only exception to that is for real estate investment trusts or REITs that have a different business models, and for them typically the payout ratio is much higher. Looking at Johnson & Johnson's last quarterly earnings report, which was announced on October 13, the company had earnings per share of $2.2, which showed 11% positive surprise compared to analyst estimates. The company reported revenue of over $21 billion, which also surpassed analyst estimates by 4.6%. In the next quarterly earnings, the company is estimated to report revenue of $21.67 billion and earnings per share of $1.84, though 15 analysts have lowered their estimates for the company's earnings per share in the last 90 days. You can see at the bottom left graph that how the the stock price of Johnson & Johnson has reacted after earnings report were released for the company. In fact, as you can see, within the past 9 quarterly earnings report, the company's stock has increased 5 times after the earnings report, and for the other 4 times, the stock price has declined. Okay, so moving on, and our last undervalued stock to buy right now in the stock market is Alibaba with the ticker symbol BABA. This stock is traded on New York Stock Exchange and was last traded at $270.74, but it is showing a fair value of $314.81 based on its real or underlying intrinsic worth. This shows an upside of 16.3% growth with a medium level of uncertainty, making it another great undervalued stock to consider or buy now. Looking at Alibaba's financials, we notice that company's revenue and operating income is growing considerably over the past several fiscal years, which is quite promising. However, the company's net profits has gone down in the last fiscal year report compared to that of 2019. Alibaba's net income related to ordinary shareholders was $4.2 billion US, which is down 60% over the same period last year, when the company had booked a significant one-time gain upon the receipt of the 33% equity interest in Ant Group. As you may know, earlier in November, Ant Group's highly anticipated IPO was suspended following a meeting between the company's billionaire co-founder Jack Ma and regulators in China, an abrupt move that threatens what was due to be the largest IPO sale in history. This led to a considerable decline in Alibaba's stock price and hence creating good opportunity for investors to buy company's stock at the dip. Looking at Alibaba's balance sheet, you notice that their current assets well exceed their current liabilities, which results in a current ratio of over 1, suggesting that Alibaba has enough resources to meet its short-term obligations. Moreover, their total assets also exceeds their total liabilities. What's more, Alibaba has a healthy cash flow from their operations, which has steadily grown over the past 3 fiscal years. Looking at peer benchmark review, you notice that Alibaba had a 1-year stock return of 46.5% compared to an average of negative 5.5% return for the consumer discretionary sector. From a stock volatility perspective, this stock has a beta of 1.28, which shows more volatility for this stock and its price when compared to the beta of 0.77% for the consumer discretionary sector. Alibaba Group Holding Limited, also known as Alibaba Group and as Alibaba.com, is a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology, which was founded on April of 1999 in Zhejiang, China. Alibaba is considered to be a growth stock and they do not pay any dividend at this time. Looking at company's last quarterly earnings report, which was announced on November 5th, the company surpassed analyst estimates for both earnings per share and revenue. Company reported earnings per share of $17.97 and actual revenue of $155.1 billion. Company's next quarterly earnings is scheduled for February 11th, 2021, and the company is estimated to report earnings per share of $21.63 and revenue of $215.5 billion. There you have it, folks, my 3 picks for undervalued stocks to buy right now in the stock market. Do you own any of these shares in your portfolio or plan to buy and add them to your investment portfolio? What other stocks are you considering to buy or watch right now in the stock market? Let me know in the comment section down below. I hope you found this video beneficial and you gained something of value from it. If you did, please be sure to give it a thumbs up and share it with someone who might benefit from this video as well. I've put a lot of time and effort to research these companies and really recommend the ones that I personally believe have a huge potential ahead of them. That being said, please make sure to do your own due diligence and research before buying these companies or any other stock in the stock market. Lastly, if you haven't done that already, please be sure to subscribe to Momentum channel. Here on Momentum, we post weekly videos about finances, investing in the stock market, and financial freedom. Hope to see you next time.